Silver is down on the session, not collapsing, just drifting, quietly, as if the market has decided to hold its breath. Volume is moderate. The tape is thin. And that calm is not a sign that nothing is happening. It is a sign that everything is about to. In roughly 9 hours, Jerome Powell will sit down in front of a room full of reporters and choose his words carefully. By the time he finishes, silver will either be pressing toward $82 or testing $78. One press conference. That is what today comes down to. So if you are watching silver right now, you are not watching a market. You are watching a waiting room. Silver futures are trading around $79.50 to $80 per ounce, down roughly 1 to 1.5% on the session. That decline is not driven by conviction. No major seller is pressing this lower. No headline blew the setup overnight. The market is selling because it is cautious, and caution before the Fed is rational. The dollar is sitting at 99.5 on the DXY index, barely moving. Range of about 15 pips all morning. A flat dollar is a neutral factor for silver. It is not helping, but it is not the reason for the softness either. 10-year Treasury yields are at 4.20%, down about 2 basis points on the day. Real yields, what you actually earn after inflation measured through tips, are hovering near 1.85%. These numbers matter because silver pays nothing. When real yields are high, there is a meaningful cost to holding metal instead of bonds. At 1.85%, that cost is still present. The slight dip today is a mild tailwind, but mild is the operative word. The tape tells the same story as the numbers. Moderate selling on the open, buyers stepping in near $79, no large block trades, bid-ask spread normal. Big participants are sidelined. The market has already done its pre-positioning. Now it waits. One number lands before the Fed, though. At 12:30 Eastern, the February PPI report hits. Producer prices in January came in at plus 0.5% month over month. The consensus for February is plus 0.3%. On a normal day, a PPI print would move the market and then be forgotten. Today, it functions differently, as a signal that could reshape the tone of what Powell says 4 hours later. Oil prices have remained elevated, West Asia tensions are not resolved, and energy feeds directly into producer costs. If the February number comes in at or above the prior reading, it gives Powell a live data point to reference when he talks about persistent inflation. That is not a hypothetical risk. It is a plausible scenario, and the market knows it. A hot PPI makes the dovish scenario harder to deliver without contradiction. Powell cannot credibly signal flexibility on rates while simultaneously pointing to accelerating producer prices. So a firm print narrows his room to maneuver, and a hawkish tone, even if he does not intend it, lands differently when the data is backing him into it. The inverse also holds. A soft PPI, say plus 0.1% or below consensus, gives him cover to acknowledge that inflation is cooling, that the risks are becoming more balanced, that the committee is watching carefully. That kind of language is all the market needs to move. Before you read the FOMC statement tonight, read the 12:30 number first. It sets the table. What do you think it prints? The rate decision itself is not the event. Markets have the Fed funds rate at 3.75% already priced in, and there is no serious expectation of a change today. Pricing in a non-event is not the same as ignoring it. It means the reaction to a hold will be zero, and all the energy in the room flows to what comes after. The statement matters, the dot plot matters, but the press conference is where price actually moves, because that is where Powell has to answer questions he did not write. His prepared remarks are committee approved and vetted. His answers to reporters are not. Two paths. If Powell signals that the committee sees slowing growth as a genuine risk, if he references global uncertainty, acknowledges that the balance of risks has shifted, sounds less certain about the path of inflation, the market reads that as a pivot signal. Real yields fall on expectations of future cuts, the dollar softens, and silver can move fast toward $82. If Powell leans into the inflation data, oil, services prices, a labor market that is not meaningfully cooled, then the message is that rates stay where they are for longer than markets hoped. Real yields firm up, the dollar catches a bid, and $78 is a reasonable test by end of session. The dot plot adds another layer. If Fed members move their median 2026 rate forecast up even modestly, that alone can reset rate cut expectations for the year. Watch the median 2026 dot against the prior projection. A single quarter-point shift higher has caused meaningful market moves before. The statement drops at 6 p.m. Eastern. Powell speaks at 6:30. The price reaction you see at 6:01 is an algorithm reading headlines. The price reaction at 6:45 is the market deciding what it actually means. The first move after the statement is almost always a trap. When the headline hits, algorithmic systems parse the language in milliseconds and execute. That initial spike or drop reflects keyword detection, not interpretation. The market then spends the next 10 to 20 minutes actually reading the statement, and frequently reverses the first move entirely once Powell opens his mouth and the tone becomes clear. Retail traders who enter on that first tick routinely get stopped out before the real direction is established. They were right about the outcome and still lost money, because they were early by 15 minutes. Fed days punish early entries. The second mistake is staying in a bad position because the fundamentals support silver longer term. They might. But a futures account does not care about your 6-month view when the margin call comes in. Holding through a sharp Fed day move because silver should go higher is how traders lose capital they needed to survive to the trade that actually works. Stop losses are not pessimism. They are the mechanism that keeps you in the game past today. The third option, and this one is genuinely underrated, is doing nothing. Cash has no drawdown. Watching a Fed day without a position open is a legitimate strategy. You learn how the market reacts, you preserve capital, and you enter after the dust settles with a cleaner read on direction. There is no rule that requires you to trade every session. If you are positioned going into 6 p.m., size small. If you are not positioned, think twice before opening something in the next 2 hours just to feel involved. Whatever Powell says tonight, 3 things remain true tomorrow morning. COMEX registered silver, the metal available for immediate delivery, is sitting near 78.9 million ounces. That is historically low, and the trend over recent months has been down, not up. Open interest in silver futures is not declining at the same rate. When the gap between deliverable supply and outstanding contracts tightens, the mechanics of the market favor those who are long physical. That pressure does not release based on Fed language. Industrial demand has structurally exceeded supply for several years running. Solar panel manufacturing, EV production, AI data center build-out. These are not discretionary uses of silver that slow down when the Fed holds rates. The Silver Institute's deficit projections reflect real physical flows. Mines cannot be permitted and built on a quarterly earning cycle. The supply response to elevated prices takes years, and the demand is not waiting. Central banks globally are aggressively accumulating gold. Chile added gold reserves for the first time in decades. China continues buying. BlackRock data suggests 95% of central banks plan to keep adding in 2026. Silver moves with the precious metals complex over time. When gold has structural institutional support, silver tends to follow, often with more volatility in both directions, but the direction itself reflects the same forces. If these 3 conditions are intact, and nothing tonight will change any of them, then a hawkish Powell does not break the silver thesis. It delays it. The price might test $78 support by morning. That is not the thesis failing. That is a better entry for people who missed the move up from lower levels. Whether today's move validates your position or challenges it, ask yourself whether any of those three facts changed. If they did not, your time horizon is what needs adjusting, not necessarily your view. Fed days are not decision days. The decisions worth making were made before the event, when the information was still incomplete and the price was still honest. What happens between 6 and 7 tonight is a test of those earlier decisions. Whether the sizing was right, whether the stops are placed where they should be, whether the conviction was real or borrowed from momentum. Silver's structural story is not resolved tonight in either direction. One press conference cannot manufacture 10 years of industrial deficit, and it cannot put silver back in COMEX vaults that have been draining for months. Watch the PPI at 12:30. Watch the dot plot at 6 o'clock. Watch Powell at 6:30. And watch what the second move is, not the first. A final note. Nothing in this video is financial advice. This is analysis for educational purposes, a framework for reading what is happening, not a recommendation for what to do with your money. Your capital, your risk tolerance, your decisions. Research accordingly.